There comes a time in any difficult journey when you grow tired of guessing. You grow weary of the noise, the conflicting advice, the frantic search for a secret that always seems just out of reach. For me, that time came in my trading journey. I was lost in a sea of complex indicators, chaotic charts. Every decision felt like a gamble, driven by hope, driven by fear, but rarely by a clear, confident plan. I wanted a method that was not a firework, exploding brightly for a moment, only to leave me in darkness. I was searching for a steady lamp in the night. Elegant simplicity over complexity. Every successful endeavor is built upon a solid framework. A house needs a foundation, a ship needs a hull, a trader needs a set of non-negotiable rules. This framework is not meant to restrict you. It is designed to free you. It frees you from impulsive decisions and the emotional roller coaster of hope and fear. Here is the simple framework that became my guide. There are only 5 rules. First, identify the dominant trend on a clean, uncluttered chart. Up, down, or sideways. This gives you context. Second, mark the most obvious levels of support and resistance, the floors and ceilings containing price. Third, trade in harmony with the trend. Flow with the current. Fourth, always use a stop loss. Without it, you are simply gambling. Fifth, use small, consistent position sizes. Risk only 1 to 2% per trade. Follow these with discipline, and trading transforms from chance to a business of probabilities. To trade effectively, you must learn to read the market landscape. The 2 most important landmarks are support and resistance. These are not magical lines. They are price zones where the balance between buyers and sellers has historically shifted. Imagine a large room, a solid floor beneath you, support, a solid ceiling above you, resistance. The ball is price, drop it. It falls until the floor stops it and it bounces. On charts, support is where declines tend to reverse. Resistance is the opposite, a zone where rises tend to stop and reverse. Find previous lows for floors and highs for ceilings. Sometimes price bounces. Other times it breaks through and discovers a new level. Use these zones to plan. Entries near levels, stops just beyond them. This image cuts through noise and gives a clear, actionable read of market behavior. The scale of success. Understanding the risk-reward ratio. Many believe you must be right most of the time. That is misleading. You can be wrong often and still be highly profitable. The key is the risk-reward ratio. Before you enter, compare your potential loss to your potential gain. Risk 1 to make 3, a 1-to-3 ratio. Trader A wins 80% but risks $200 to make $50, net zero. Trader B wins 40% at 1.3, net profit. Positive asymmetry lets bigger winners outpace smaller losers. Losses become routine business costs. You manage probabilities. You do not predict perfectly. This is the mindset of a professional. The method in action. Entry, stop loss, and exit. Planning is one thing. Flawless execution under pressure is another. Make it mechanical. Your job is to execute the plan you prepared calmly. Step 1. The entry. Buy near support in an uptrend. Sell near resistance in a downtrend. Do not enter blindly. Wait for rejection. A pin bar or hammer shows the level held. Enter only after the confirmation candle closes. Step 2. Set your stop loss, your most important action. Below the low for buys, above the high for sells. Room to breathe, small loss if wrong. Set it as you enter, never enter without it. Final step, define a logical target with favorable RR. Aim for 1.2 or 1.3. Next resistance from support is a logical target. The bedrock of survival, mastering risk control. This is the bedrock of a trading career. Without it, even great strategies fail. Most chase money. Professionals protect capital. Protect what you have, and growth follows. Your primary tool is position sizing, how much you allocate to one trade. Risk only a small percent, typically 0.5% to 2%. On $10,000, 1% means a $100 max loss. Small fixed risk is your defense, financial and psychological. Even after 10 losses at 1%, you are down 10%. Wounded, not out. Risking 10% or 20% per idea is fatal over a few losses. Risk control lets you be the casino, not the gambler. A quiet transformation. A personal note. Before this method, my trading mirrored inner chaos. I chased prices and acted on tips, then held losers hoping for reversals. The change did not happen in a day. It was slow and quiet. I started with bedrock risk control, cutting size to 1% per trade. Early results were modest, small wins and small losses, but I felt calm. A detailed journal became my teacher and showed discipline drives profit. Built on a 1.3 foundation, wins began to outpace losses. Discipline bled into life, more patient, more methodical, more comfortable with uncertainty. Make risk control your most sacred rule. Embrace simplicity, follow the rules, be patient, and let the market come to you. This calm, steady method changed my life, and it can change yours too.